Welcome to this explainer. Okay, today we're diving headfirst into the complex and honestly pretty confusing world of ESOP taxation. Look, if you've been granted employee stock ownership plans, congratulations! It is a fantastic way to build wealth. But as with any kind of wealth, the taxman is always waiting in the wings. It can be a massive source of financial anxiety if you don't know the rules of the game. So today, we're going to transform that anxiety into empowerment. By the end of this explainer, you'll know exactly how to navigate these waters so you don't get hit with any sudden cash flow crises. Let's dive right in.
So, let's kick things off by busting literally the biggest, most dangerous myth out there. A lot of folks believe they only owe taxes when they actually sell their shares and see that cold hard cash hit their bank accounts. But did you know your ESOPs are actually taxed twice? That's right, the taxman comes knocking way earlier than you might think. And this specific misconception is exactly why so many people get caught completely off guard.
To keep us on track through this dense financial roadmap, we'll follow a clear agenda. We're going to cover the ESOP tax reality, the two-stage tax structure, startup relief under Section 80IAC, avoiding common tax pitfalls, and finally, your pre-exercise strategy.
All right, Part 1, the ESOP tax reality. Let's just start by grounding ourselves in the standard life cycle of an ESOP before any taxes actually come into play.
You get the grant on day one, and you vest over, say, 1 to 4 years. But here's the kicker. Neither of those are taxable events under Indian law. You owe absolutely nothing at this stage. The tax clock only starts ticking on the action day, the day you actually decide to exercise those options and pay the price to get your hands on the shares.
Moving on to Part 2. The two-stage tax structure. This right here is the core conflict that catches so many folks off guard.
Okay, you've got to remember this dichotomy. Stage 1 hits you with a perquisite tax simply for exercising your options and getting the shares. Yep, even if you haven't made a single dime of actual cash yet. Then there's Stage 2, the capital gains tax, which only kicks in way later when you finally sell those shares in the open market or back to the company.
So, let's break down Stage 1. What on earth is this perquisite value? Basically, it's the fair market value, or FMV, of the share on the day you exercise minus the exercise price you actually paid your company. The wild part is that this financial gap, this purely hypothetical paper profit, gets added directly to your salary income. It gets taxed at your normal slab rate, meaning your employer will deduct TDS and your actual take-home pay might plummet that month to cover the bill, even though no new cash entered your pocket. Talk about a painful irony, right?
To put this into perspective, let's look at a hypothetical guy named Ravi. His company granted him options at an exercise price of 40 rupees, but on the day he exercises, the fair market value is 340 rupees. That's a perquisite gap of 300 rupees per share. If Ravi exercises 1,000 options, boom, he just instantly added 3 lakhs to his taxable salary for the year. His employer is going to withhold taxes on that 3 lakhs straight from his regular monthly paycheck. This is exactly where that dreaded liquidity crunch happens.
But fast forward to Stage 2. When Ravi eventually sells his shares, he has to pay capital gains tax. The good news here is that the government doesn't tax you twice on the exact same growth. The capital gains are calculated from that 340 rupee fair market value he already paid perquisite tax on, not his original 40 rupee exercise price. The gain is just the final sale price minus that 340 FMV. So this structure perfectly avoids literal double taxation on that initial growth window.
All right, Part 3, startup relief under 80IAC. Having established that painful Stage 1 cash flow problem, let's look at a much-needed lifeline specifically designed for eligible startup employees.
Look, startup employees usually don't have the cash laying around to pay a massive tax bill on illiquid shares. The government gets this. So if you work for a DPI IT-recognized startup under Section 80IC, you can actually defer paying that immediate perquisite TDS. You don't escape the tax, but you do delay the cash outflow until one of 3 triggers happens. 5 years pass from the date of allotment, the date you sell the shares, or the date you quit the company, whichever comes first. Just a heads up though, if you resign, that tax bill suddenly crystallizes, and that catches a lot of departing employees completely by surprise.
Let's shift gears to Part 4, avoiding common tax pitfalls, because you absolutely need to know where the hidden landmines are that could trigger severe penalties if you aren't paying close attention.
So, have you ever heard of advanced tax? In India, if your yearly tax liability jumps over a 10,000 rupee threshold, you have to pay advance tax in quarterly installments. Because an ESOP exercise suddenly spikes your taxable income, salaried folks who usually just rely on their employer's TDS suddenly find themselves crossing this threshold. And if you miss those quarterly payments, you're looking at heavy interest penalties under Sections 234B and 234C. Don't let a huge wealth-building event drain your wallet in penalties, you know? Oh, and here's another massive pitfall for those of you at multinational companies. If your ESOPs come from a foreign parent company, congratulations, you're holding foreign assets. You absolutely must disclose these shares under Schedule FA in your income tax returns, even if you haven't sold a single one yet. Skipping this disclosure isn't just a minor slap on the wrist, it can actually trigger massive, crippling penalties under the Black Money Act. So always report your foreign holdings.
And please do not confuse ESOPs with restricted stock units, or RSUs. Companies use both, but they are totally different animals. Like we've learned, ESOPs have an exercise price, and taxation triggers when you exercise. RSUs, though, they carry no exercise price. You just get the shares. Which means RSUs are taxed immediately at the vesting stage. If your compensation package happens to include both, you really have to track two entirely different timelines.
Bringing it all home with Part 5, your pre-exercise strategy. We've covered a lot of ground, so let's turn all this complex tax theory into a concrete, actionable plan you can actually use.
The absolute most crucial takeaway here is never just click exercise blindly. Work through this 4-step checklist first. Step 1. Estimate your perquisite tax using the current fair market value. Step 2. Double-check that your personal cash reserves can actually cover both the exercise price you owe the company and the tax your employer is going to deduct. Step 3. Take a look at your full-year income. Does this exercise push you into a higher tax bracket? If it does, maybe hold off until next year. And Step 4. Always request proper FMD certificates and TDS proofs from your employer. Doing this ensures you don't accidentally trigger a liquidity crisis for yourself while trying to build your wealth.
Ultimately, this whole explainer really boils down to this one simple rule. Don't let your bonus become a burden. By keeping clean records like grant letters, exercise notices, and valuation reports, and by planning your exercises around your actual real-world cash flow, you can turn your equity from a terrifying source of stress into a brilliantly managed pillar of your long-term financial future.
We really hope this structured breakdown empowers you to take absolute charge of your equity. Yeah, the rules are complex, but they are totally manageable when you actually know what to expect. So looking at your own portfolio, it leaves you to ask yourself, are you truly prepared for your next big financial milestone? Time to fire up those spreadsheets and take control of your equity before it takes control of your cash flow. Thanks for joining me on this explainer. Now go plan your next move.